introduce the next set of speakers. We're in for a bit of a treat. We've got a number of speakers that have come from the IFoA Working Party on Insurtech, and a subset of that which focuses on parametric insurance. We've got 4 speakers coming up now. They are Raghav, who's a non-life actuary working with insurers across the Middle East and focusing on health and motor pricing. He leads the parametric workstream as part of the IFoA GI Insurtech Working Party. We have Shyam, who is pricing manager at Aviva Global Corporate and Specialty. We have Shyam, who's a consulting actuary at Willis Towers Watson in the UK. And we have Christine, who's a corporate actuary at Swiss Re with reserving experience across all markets and lines in Asia and Australia. So with that, I'd like to hand over to the team on parametric insurance.
Thank you, Mehul. Thanks for the introduction. And let me just get started by sharing my screen. Okay, so firstly, small update there. Xian used to be at Towers Watson, but last couple of months have been eventful, and now she is actually in Singapore at Guy Carpenter. But the rest of us are where we are. So let me just see. Okay, I think this should be clear. All right, excellent. So as Mehul mentioned, we're part of the GI Insurtech Working Party of the IFoA. The Working Party has been sort of working towards our paper for Gyro as well as a presentation at Gyro, and it consists of 4 work streams. The parametric one is one among these 4. Work from all 4 work streams was presented at the Gyro conference. So, and Ed, who presented earlier, is heading this work stream. So if you liked what things that he mentioned and things in this presentation, hopefully, please do have a look at our paper and when it comes out in the next couple of months, or at the presentation at Gyro, which should be on the IFoA website. So with that, I'd like to start off with a quick summary on parametric insurance. So firstly, parametric insurance is, for those who don't know, is based on the usage of a parameter, which is correlated to the loss. It's not exactly equal to the loss, but it's correlated. Like traditional indemnity products, there's 2 defining characteristics of parametric insurance. You need a measurable trigger and a fixed compensation. And these are generally agreed in advance, leading to faster payouts and low claims admin costs. Historically, the providers of parametric solutions have been bespoke service providers, mainly dealing with climate and catastrophe perils for larger risks. But lately, enabled by technology, better data and modeling techniques, a newer cohort of Insurtech offerings are moving towards off-the-shelf products focused on SMEs and individual customers, helping to meet gaps in indemnity product, providing liquidity when the customers need them the most, and covering otherwise uninsurable risks. So this is a very brief summary about what we're going to be speaking about over the next 30 minutes. The agenda for today is, well, we're going to talk about where parametric is today and how Insurtech is enabling it. We're going over case studies, 5 of them, where we've spoken to these individual teams ourselves. And then we're going to touch upon briefly where we see actuaries fitting into this and how we see the future of parametric insurance playing out. So with that, I'd like to hand this over on where parametric covers are today.
So on this graph, we can see it's mainly a split of tangible versus intangible assets for the S&P 500 over time. And why is this graph important? It's kind of the notion where we can see intangible assets in today's terms is a larger proportions of companies' books compared to previously, where tangible assets are mostly in the books. And why is this important is because insurance actually started out as kind of like marine cover, physical damages, coverage to property, or kind of fire or theft. But today, we are kind of more aware and conscious of risks that are uninsurable or kind of intangible losses. For example, you have brand or reputational damage, or even cyber and climate related losses. All these coverage, it's kind of like in the industry, there's few or maybe no coverage. And this is where we think parametric insurance can help. And with that, if we look at the main differences between parametric insurance and traditional based indemnity-based covers, the key difference is the types of things that they protect. Parametric insurance is kind of like provides quick payments, short term, and it's fast. So it protects a company's cash flows compared to indemnity-based insurance, where it actually protects the balance sheet. What this means is where if we look at the payment triggers for indemnity-based covers, they actually, only an actual loss is triggered, and basically you need kind of claims management teams to assess the damage, and it takes time. And the recoveries is not based on a predetermined amount as we see in parametric insurance. It's mainly based on the reimbursement of the loss of damage that has been assessed. So having this in mind, if we look at where we are in terms of parametric insurance today, the first graph is a summary total over the periods of time of the parametric solution providers in the market. And we can see the split is mainly with data providers, and then slowly you'll see analytics agencies and MGA brokers coming to second and third. In the second graph, it then breaks down the split over time. And we can see that over time, there are more and more MGA and brokers in kind of entering the insurance market as technology is more advanced compared to 2 or 3 decades ago, where mainly the providers of parametric insurance were data providers or analytics agencies. And of this breakdown, majority of these companies provides weather-related or catastrophe cover, and very, very few of them, only a handful, provides non-weather related cover. So one of the examples of these in the next slide is parametric insurance. In the first one, we can see where this is the company collaborated with Lloyd's to develop a business interruption product. And this covers IT downtime for various sort of like web services or payment services. And with that, parametric insurance also provides, there are also a few risks for parametric insurance where Shyam will talk about basis risk.
Yeah, so basis risk is the risk that payments made by the parametric insurance product end up being more or less than the loss that is incurred by the insured. It is an issue that was highlighted by all of the providers in our case studies. And one of the key aims in building a parametric insurance model is to try to reduce basis risk as much as possible. So I'll give an example of weather insurance where basis risk has caused issues in the past few years. So imagine you have a farmer who wants to take out insurance against excess rainfall or drought. The first example is spatial risk. The spatial risk here is that the weather encountered at the farm is different to the weather experienced at the weather station, and the weather station is being used to determine if there is sufficient rainfall or too much rainfall. So that's where you decide if the trigger is going to be met or not. So this is more of a problem if the farm is quite far away from the weather station. You could get different weather at the weather station compared to the farm. The second type of basis risk is design risk. So this is the risk that the model design does not end up reflecting reality. So for example, the assumed relationship between weather and crop yield that is used to build the parametric insurance product could be incorrect. If it rains heavily and the crop fails, but the amount of rainfall did not hit the trigger level, which is when it is deemed that the crops would be expected to fail, then the farmer won't get any claims payments. Similarly, crops could be affected by another peril unrelated to rainfall, which is not covered, but may have been covered by a more expensive traditional indemnity cover. Also, yields vary depending on the actual crops that are being used by the farmers, and a single index and trigger may not be suitable to cover all of the different types of crops. The last type of basis risk is known as temporal risk. So at the outset, it will have been agreed between the farmer and the insurer which weeks or months of the year that the parametric cover is going to be in place for. So the highest risk periods for drought or flood will be expected to be covered in that period, which is the same period that the crop is growing and is therefore dependent on the rainfall. However, there's some randomness here. It could just be that the risky weather or the growth stage of the crop occurs outside of that insured period. And there's just this timing risk due to randomness that is difficult to get exactly right in the model. Next, we're going to talk about our case studies of various parametric insurance providers. So Floodflash is a UK Insurtech, and it's the only UK company that covers flood and no other property peril. They provide a mobile connected sensor which is attached to the outside wall of a building, and the trigger height for the cover is the height of the sensor above ground. If there is a flood and it reaches the height of the sensor, then the claims trigger is met and Floodflash will be notified automatically. They will then make the pre-specified payout to the insured within 72 hours. The target market for Floodflash is SMEs who may not be able to obtain cover from a traditional indemnity insurer, or if they can, the cover may have low limits or be very expensive, especially if the building is located in a high flood risk zone. They can offer lower premiums than a traditional indemnity insurer because their claim amount is fixed and selected by the insured at the outset. This means that there's no need to allow for things like loss adjustment costs, claims handling costs, and legal and other costs in the premium. Traditional indemnity insurers have to deal with the uncertainty over claim amounts and how they develop. And because of this, they have to allocate more capital to policies compared to parametric providers like Floodflash, and higher capital loadings mean higher premiums. So this is another reason why Floodflash are able to keep their premiums lower. A couple of risks that we identified with Floodflash and all parametric insurance products are aggregation and underinsurance. So multiple buildings in the area will likely be affected by a flood, so there's clearly an accumulation risk. However, Floodflash said to us that if the risks are priced properly in the first place, then accumulation of risk is not such a massive deal. Underinsurance can occur because the insured has to select the level of cover, and they could end up suffering more damage than the limit that they pick for the policy. Again, we asked Floodflash about this, and they said that they can provide surveyors to help insureds to decide on an appropriate cover level. And it's also possible to buy multiple policies where you can place sensors at different heights and select different cover levels. So this can help protect against floods of different severity. So I'll hand over to Christine.
Roughly about 75% of global agricultural crop production is not insured. This is down to a lack of local knowledge, low efficiency in insurance product distribution, limited access to innovative solutions, and poor data quality. Imagine I'm a cabbage farmer. I may decide not to buy an insurance policy if it is too expensive. Or if I had bought it in the past, but had difficulty getting insurance payout when my cabbages were not doing very well. Or it could be because the insurance payment took too long and I feel cheated by the insurance companies due to lower than expected insurance payout. This is where the soil moisture by SWOT comes in. Soil moisture is a good proxy for yield. SWOT has an exclusive partnership with VanderSite, offering remotely censored soil moisture data. The data are very detailed with high spatial resolution, and it is updated daily. Farmers can assess current and past conditions of crops, compare their fields to those of their neighbors, and also receive precipitation forecast. It makes real-time data available to farmers. As the payout and trigger of payout are transparent, this helps to build trust among farmers and insurance companies. Insurance companies can automate their operations, reduce operational frictions in agricultural insurance. This will reduce operational risk and therefore improve results. The next case study is Qomplx, a UK company. They cover cyber data breach, cyber service outage, and terrorism disruption. Their target market are SMEs. For the cyber breach cover, if the policyholder's electronic system are breached and are required by GDPR to forward a personal data breach notification to ICO, policyholders can provide the ICO incident reference number to claim. For the cyber service outage cover, if one or more third-party electronic service suppliers suffer an outage, policyholders can notify Qomplx of the duration of the outage claim. The terrorism disruption cover provides protection for business interruption from a terror event, regardless of physical damage. Policyholders get a fixed limit payment for the terrorism event occurring in their postal code zone. This will provide the cash flow to help business. For example, if I have let's say, ice cream shop at Cambridge, and there was a terrorism attack, though my shop was not directly affected by the attack, less tourists and students may visit my area, and my ice cream sales will be affected. In this case, I could use the insurance payout to pay rent and other expenses. Compared to traditional insurance, the average cost is estimated to be only about 5 to 10% of the current insurance spend. The triggers are clear, simple, and objective. The payout process is also faster than traditional cyber insurance, as there's no need to determine the amount of actual loss. In addition, customers can choose their own limit. The range is from about £5,000 to £100,000. Similar to the previous case study, there could be aggregation risk for Qomplx. For example, if one of the main cloud provider has an outage and many other service providers get affected at the same time, but this could be mitigated by the correct pricing and pricing model. As the limits are chosen by policyholders, there could be under insurance. Now I'll pass the next case study to Shyam.
So this is one of the last commercial lines case studies for parametric insurance. And this is about Skyline Partners, founded in the UK just 3 years ago in 2017. Skyline Partners is an index insurance solutions provider, and it provides white-labeled solutions to clients focusing in the space of agriculture and renewable energies. And of course, they look to continue developing their technologies into different areas of business in future. So how did Skyline Partners come around? One of the reasons is where the founders of the company realized one of the key challenges currently is in clients adopting parametric insurance solutions was that there was a lack of knowledge or kind of like low understanding of the parametric insurance product, which led to low adoption or like not buying the parametric solutions at all. So with that in mind, they then set out to create a platform that helps buyers and partners try to understand the data or the risk that is being insured. And this platform is now called Index. And this platform actually allows users to visualize risk. If, for example, you're able to, in that platform, set up various types of parameters, for example, solar radiation or rainfall. And you can actually aggregate or zoom in into various time periods or geographical regions as you'd like. For example, the span of 2015 to 2020 is the full data set. You can zoom into a specific year of 2017 or zoom out to kind of the full data period if you like. The main benefit of this solution is that because the platform uses one single point of data source and it's quite versatile, users can actually use this platform as a way of monitoring their risk, at the same time also understanding their own losses. So it creates a consistency between the expectations of risk and also the actual experience of risk. So However, when Skyline Partners were developing this index platform, one of the data challenges that they also wanted to overcome was to reduce the need that they need to manipulate data or in a situation where there's no data available. For example, like Shyam previously mentioned, that physical data sources such as weather station. So it may not be available. So how did they overcome this challenge? Is they did it by using satellite data instead of weather solutions to measure risk. So as we can see, the sources are from like NASA or NOAA, and it spans across a long time period with billions of data points, and these data points are across like 40 years or 17 years. So this is finally, with this solution, we can see that index actually is then transparent, low cost, and very scalable. So the next case study that I'm going to talk about is Swiss Re Travel product. And this is a personalized travel insurance product created by Swiss Re. And why is a parametric design suitable for travel insurance then? So the main reason for this is because it allows us to create value for customers where the loss insured is realistically possible, although uncommon. So firstly is where if we take a look at the conventional travel insurance products available on the market, according to Swiss Re, one of the products cover flight delays of the conventional products provides cover of flight delays for as long as like 6 hours. And this is actually quite an unlikely event to occur, where based on the analysis on flight delays globally before COVID-19, only 15% of these flights are delayed by 30 minutes, and as low as 1% of the flights are delayed by around, like, let's say 4 hours. So secondly is the way we book connecting flights have also changed. So as technology became more advanced with the appearance of flight aggregators, for example, Skyscanner or Google Flights, you see that virtual interlining becomes more and more common nowadays. What this means is for two connecting flights, you can actually book them separately and individually. And therefore, if your first flight is delayed, there's no guarantee for your connecting flight to actually wait for you. And having this in mind, if we move on to the parametric travel insurance that Swiss Re created, we look at the trigger time delays. It's kind of more realistic in terms of 30 minutes to like 3 hours instead of up to 6 hours. And the event also includes connection delays, including connecting flights that were booked separately. Finally, let's move on to look at what type of analytics is behind the product design. So instead of using historical loss ratios, the way they price the product is they use various types of correlating factors that are priced daily. For example, which airline are you flying with? Which airport are you flying out of or entering in? If, for example, if you were flying out or into New York's JFK Kennedy International Airport, like previously, there would be a higher chance that your flight would be delayed because there's a higher volume of air traffic. So, or which day are you flying in? If you were to fly on a bank holiday where most people travel, then this generally also increases the chances of your flight getting delayed. One point to consider is the way the correlating factors were used, as you can see, it spreads across, like averages across 5 to 10 years. So when this method actually led to the product being negatively impacted by COVID-19, because when all flights were cancelled during the short term of like 3 to 6 months, this impact was not reflected in the premiums because the impact was averaged out across like the period of like 5 to 10 years.
Thanks, Shyam. So I'm going to be talking about something closer home for most people attending, which is the droplet product at NTUC Income. So this is also a parametric product, which is helping consumers who use ride-sharing apps such as Ride, Gojek, or Grab to protect against rain-related surges on their cab fares. So the trigger is essentially rainfall over a certain level. If a user were to hail a rideshare at that point and it is raining above a certain amount, then they are compensated by the insurance company. So the product, as we mentioned earlier, is very individual focused. You've got very low premiums and very clearly defined triggers. And given its low ticket size, a traditional indemnity sort of loss adjusting kind of approach would have been out of question. So the current process is very, very straightforward. You get the email from the rideshare, the ride hailing app, and you just have to forward the receipt email to Income, and they will process it, and bots will be able to figure out, firstly, when did you take the ride, what time, and what location did you take it from. And based on the location and the time, they're able to query the Singapore government's public APIs. So there's 50 weather stations around the island, and you find out the closest one, and you measure the amount of rainfall at that time. And if it is crossing that trigger, you meet all the requirements, and you're given back 60% of your fare. And obviously, such a product is challenging in terms of aggregations, because you are looking at a relatively small geographic area, but this is something which is being priced in, of course. So you are buying cover, for example, for the next 7 days or 14 days or the next 30 days. And I just checked the weather forecast today. It looks like there's rain over the next 7 days at least. So, rates climb. And this is the sort of direction we see. The reason I personally was quite interested in this product is because it's enabled by the new technology. You're able to get access to this public data, which is perceived as public and free and therefore fair, because there's this transparency and openness now that both you and the user have access to this common source of data, and it's not as sort of black box as Parametric used to be. So moving on from the case studies into where do actuaries fit in, since this is the audience here. So I'd say split this into two broad areas. Would be sort of a more traditional approach, where we say talk about pricing, product development, reserving capital, and then wider fields, where actuaries can definitely add value within the Insurtech space, and particularly within Parametric. So within pricing and product development, well, we know that in theory, Parametric should be easier to price than indemnity products, because the index can be valued historically, so the historic loss cost is known. However, this is not always the case. There are some challenges within this, and obviously, yes, the other advantage is the severity is known. So that's definitely making our job a little simpler. It's the technical complexity, however, usually lies in the construction of the index. So something like Floodflash needs a lot of geologists at the back end being able to model flood risk down to not just to your postcode, but within your postcode down to your exact location and your height above sea level and things like this. And that leads me to this point on big data sources and new technology. So we need to look at collaboration with other disciplines and upskilling, both upskilling in related areas, data science and machine learning techniques, and collaboration with other disciplines. So whether or not we can do neural nets on our own, as I'd mentioned in his presentation earlier, is not really the point, but can we at least collaborate with the people who are working on this? Moving on, reserving and capital, not that relevant, again, from an actuarial point of view. That's how we see it. But wider fields. Can actuaries who've got a foot in the door thanks to our more traditional roles work in areas like strategy or technology or management, and be perhaps an interface between those developing the technology or being the front end of this Insurtech change on the technical side, and insurance veterans? Can we be something in the middle? And that would obviously require a lot of change in culture and upskilling, but this is something I think we should be keeping our eyes and ears open to. So with that, I'd like to hand over to Shyam to speak about the landscape for the future of parametric insurance.
Thanks. The next couple of slides will look at technologies that are helping to increase the scope of parametric insurance and areas where we expect parametric insurance to have an impact. So the first technology is the Internet of Things. It's estimated that there are around 20 billion devices globally that are connected to the internet, and data from these can be used to construct parametric indices and triggers. Overall, we have found though that Internet of Things is not being used a great deal, but a couple of companies that have been able to utilize it are Blink, Parametric, and Parcel. The Blink Parametric is a platform that lets insurers connect to customers to offer them parametric insurance against things like the breakdown of domestic appliances. So they'll use smart devices and sensors to determine when an appliance has stopped working, and that will then trigger an alert to be sent to the insurer. The insurer will then either pay out a cash amount or arrange for the appliance to be fixed. The other company that we've highlighted is Parcel, and they've been getting a lot of media attention this year. I'm sure everyone's been watching the news about the COVID vaccines, and I guess something I've learned about is that a lot of vaccines have to be refrigerated and stored within a narrow range of temperatures. Parcel have sensors that monitor the temperature within the fridges, and if the temperature goes outside of the acceptable range, then the vaccines are worthless. So in that case, the sensor will automatically inform the insured of the breach and make a payout within 72 hours. So kind of expect with the couple of the COVID vaccines announced over the past couple of weeks to have to be stored at very low temperatures, that could mean more business coming Parcel's way. So the next example of the use of technology with parametric insurance is smart contracts and blockchain. These are ideal for parametric insurance because they are contracts where that are coded. So everything in the insurance product's life cycle, such as the policy being bound, premium collection, assessing if the trigger has been breached, and claims payment can be automated. As a result, this means that claims payments can be made quickly, and the overall expenses of using a smart contract are lower compared to traditional indemnity insurance product, and that makes premiums more affordable. So AXA is one of the major insurers that trialed a parametric insurance product using a smart contract. This was a flight cancellation product called Fizzy. It was launched in 2017, but was withdrawn at the end of the trial as they found out that take-up was not very high. And the Insurtech that has made it work is a company called Arbol, and they have a parametric insurance product that's based on the cryptocurrency Ethereum. The cover can provide protection to farmers against perils such as droughts, and the way it works is that the farmer and investor will both contribute Ethereum within a smart contract, and they will receive a weather immunity token, which is a smart contract. At the end of the policy period, an API is used to assess if the trigger coded in the weather immunity token has been breached. So was there insufficient rainfall? If the trigger was breached, then the farmer gets to keep the investor's Ethereum, and if it was not breached, then it's vice versa, and the investor gets to keep the farmer's Ethereum. So next, I'm going to talk about areas where we expect parametric insurance will have an impact in the future. It's already starting to be used as a form of microinsurance in third world countries, and we expect that the usage of parametric insurance in this area is going to increase a lot more. Traditional indemnity insurance does not always have a high penetration in the developing world, and parametric insurance has the advantage that everything from premiums to claim payments can be done simply and at a low cost. So there's potentially a really, really big market for parametric insurance here. The next area is SMEs. So taking the UK as an example, the regulator in the UK has highlighted that underinsurance is a really big issue with SMEs, and they don't tend to have sophisticated risk management departments. Simple, easy to understand parametric products would work well with SMEs, and a couple of the companies that we covered in the case study, such as Qomplx and Floodflash, have already started to make progress with SMEs. So the last area that we've highlighted is personal insurance. And again, it's the simplicity and speed of payment that can make parametric insurance ideal for protecting customers. In the US, there are a few startups that have started to use parametric insurance in the NatCat area. An example is Jumpstart. If you go to their website, they've got a really big headline that says, no paperwork, no adjusters, and no delays. They measure the intensity of the earthquake at the location of the insured using data from the US Geological Survey, and they can assess if the peak ground velocity is more than the trigger of 30 centimeters per second. So they only provide a simple single limit of $10,000 for the insured, and if the trigger is breached, then the next day they'll deposit the $10,000 in the bank account of the insured. I'll now hand over to Shyam.
So in addition to the areas of IoT, smart contracts, and the specific insurance areas previously mentioned, where parametric insurance could develop, there is also actually a huge potential in the non-nat cat or weather-related lines of business or perils, as we can see in the graph to our right, where other lines of business are kind of a quite fairly small proportion of the overall parametric space. And this graph was actually taken from the Insurtech London Parametric Insurance 2021 report. It is actually quite a comprehensive report. So if any of you are interested in knowing more about the parametric insurance, I'll definitely recommend anyone to go pick up the report. So coming back to the topic, where we can see that there are potential growth in other lines of business other than catastrophes. We take cyber, for example, where it's noted it's a 60 to 100 billion market, but actually currently it's only worth around like 7 to 8 billion, and that's actually just around 10% of what it actually is. So with parametric insurance, where the parameters are made available, where there's a parametric design which is simple, straightforward, and potentially scalable, this could actually help in providing a more common cyber coverage. And we also see that parametric insurance being a more common topic among insurers during renewals nowadays. So with that, and finally, I'll hand over to Christine to summarize our presentation.
So here are the two main takeaways from the presentation today. Firstly, parametric insurance can close the protection gap for traditional indemnity insurance by using technology like the Internet of Things, sensors, or machine learning. Parametric insurance is also like venturing into cyber, flag cancellation, and rate sharing. Sometimes parametric insurance can even provide better solution than traditional indemnity insurance. Lastly, as actuaries, we need to adapt. We need to learn to work with insurtech companies. We need to contribute to improving parametric models to reduce basis risk and other risks. We also need to improve our data science skills. We hope you enjoy the case studies and insights we shared today. If you want to know more about the case studies or insurtech in general, stay tuned. We'll publish a general paper with more details. Let's now move on to Q&A.
Brilliant. Thank you very much for that very interesting presentation, and really appreciate sharing of those case studies, with one particular one which has a Singapore flavor to it. There's a few questions coming in, and hope we can kind of get through them. The first one is about the regulatory space. I guess I would say the question is about whether Singapore MAS has started to allow parametric insurance to be offered. I mean, the fact that we've seen the example from Income may answer that. But I guess a question out of that is, do you see there being barriers or other challenges from a regulatory front around this? And I'm also thinking perhaps from a capital perspective, we're introducing potentially different types of risks to the, I guess, to the downstream to shareholder, to the policyholders eventually. The capital regimes typically are lagged behind the development of the types of risks that get insured or insurers are exposed to. What do you see in that space? Is there any kind of forward thinking that's happening in that area, or is there a regulatory arbitrage opportunity that's arising?
Thanks, Mehul. From the case studies, when we've spoken to providers of parametric services across the globe, more or less, there's been differing responses with regards to regulatory feedback. There has been initial concern that this is a form of a derivative, or maybe a bet, because you could in theory take out this insurance even if you don't have an insurable risk. And that's what startups have really had to focus on, is that we care of the fact that there is an underlying loss to the insured, and that is what we're trying to cover, and that this is not a derivative or an ILS or something of that sort. So regulatory opinions vary. I think some are more accepting than others on this, and the biggest concern would be underinsurance, and the concern that is the product that's being pushed onto the customers, is that really meeting their needs? Are they perhaps, are brokers perhaps being educated enough to make sure that the product being sold is suitable? If it's a personal lines product, is it being communicated well? These are definitely things which, it's a new area, to be honest. And I think from the capital point of view, this will definitely evolve, and depending on how much this grows, and if it does catch the attention, and then what are the key risks underlying it, those will get highlighted, and capital regime sort of improve to allow for it.
I think that's an interesting one, particularly the underinsurance point, because I guess traditional indemnity cover indemnifies for a loss of a particular, if your home is flooded, you get payout for that. And here we're picking up indicators of the fact that the home will eventually get flooded because of an event. So the kind of correlation, or let's say causation, between the trigger event and the actual loss that occurs for a policyholder,
it's interesting you brought up the home insurance example. Sorry, Mehul. It's interesting you brought up the home insurance example, because that's something which there was a survey by Deloitte of home insurance owners in 8 developed countries, and the #1 feature which people want from their home insurance is something like a parametric cover, which is to say an instant payout the moment a disaster has happened. So there is definitely this pull on personal lines as well, where people are saying, I don't necessarily need that loss adjuster to come to my place, survey after a week, give their results after 2 weeks, and then have that negotiation with the insurer, which carries on for months. I need the money instantly. And the startups we're talking to are promising that, 24 hours, 48 hours, and you'll have the money in your bank account. And a lot of that is enabled by obviously the fintech technology, which allows you to, like, for example, NTUC Income is transferring directly based on just your mobile number. So you're not talking IBANs and checks and whatever. All of that is out of question. So really, there's definitely a pull from the customer point of view as well.
I'm just going to move through some of the questions that are coming in. Thanks for that, Raghav. What is the benefit, two-part question. What is the benefit of weather insurance, parametric weather insurance, over traditional insurance, which pays out on occurrence of an event? I think you've touched on it as well. But then in terms of premiums, is parametric insurance, maybe on a like-for-like basis, sort of, is it more expensive than traditional insurance for similar cover?
Well, if you break it down, you don't really have the loss adjustment expenses. So for that, from that point of view, it's lesser. And because you're, like for like is a difficult question to answer, because the underlying loss itself is now fixed. So the customer, if they were paying for a million, they were paying X, then for 2 million, they're probably going to pay 2X, so it's just a simple multiple. So all in all, for larger risks, larger cat risks, it is cheaper. And that's why you have a lot of the facilities, at government levels, at, pan-continent levels. So you have an Africa level reinsurer, which is, for example, sourcing parametric capacity for catastrophes across the continent, as opposed to, getting indemnity risks. Getting that data to begin with would be a challenge. What exactly are we covering? That's a far harder question to answer. So
Yeah.
I think I can take the weather one.
Thanks for that. Yeah, that's interesting. Sure.
I think with the weather one, I think what we found is that a lot of in the developing world, the penetration of traditional insurance isn't very high. So it's kind of just understanding of insurance with kind of farmers just isn't really there. And I think we were looking at one in Kenya, the way they've designed kind of a parametric insurance against the failure of seeds growing is to actually, when the farmers purchase the seed, it's all done through, there's a barcode on the bag of seed, and they, it's very simple. They scan the barcode, everything kind of gets taken care of. And then if it doesn't rain, they'll automatically get the money to their mobile phone. So it's kind of very simple. They don't have to have a massive understanding of insurance. They just know that if the peril occurs, they'll get the money, and it happens very quickly. And what we've seen is where things have gone wrong. There's been a couple of examples, I think, in Africa where it's gone wrong. Then the distrust of insurance has gone up, and the year after there's been a much lower take-up of insurance as a whole. So I think it's more kind of parametric insurance is easier to understand, quicker, and in developing world that's going to be a really big thing.
Yeah, that's interesting. I think saying is it satisfies I guess gaps that are beyond just the protection gap. It's the actually the underinsurance part, or the underserved as well, is a place where there's a gap that can be filled. There's a specific question related to slide 23, but it says how can parametric insurance be applied to health insurance? So perhaps it's referencing 23, the next slide, and that little yellow box.
Shyam, do you want to take this one?
I could give it a go. We haven't actually particularly focused or looked into health insurance, but I'll imagine the way it the way you can do it is to select a suitable trigger, and it really depends on what type of trigger illness that you can kind of do. For example, blood pressure. I'm not sure like how you could potentially use blood pressure or kind of like cholesterol levels. But I'm not sure if any of the members, you guys have any idea? I would imagine.
So I work at A&H, and A&H is already a type of parametric product, because you think about kind of disability is if you break a bone, then you get a fixed payout. If you kind of die, you get a fixed payout. So there's already, I think, an element of it being a type of parametric product. I think because the insured knows that as soon as that event happens, they're going to get a certain amount. So I think that's why I probably focus more on the other lines of business in other areas.
The other question that's come up is for certain types of insurance with multiple aspects of coverage. For example, cyber, which covers data breaches, response costs, third-party liability, different, let's say, different types of coverage. What kind of triggers would be appropriate here?
Christine, you want to give this a go?
Yeah, sure. So for example, for the Qomplx example, for the data breach, they use the IMO incident number as the trigger. As for the Singapore case, maybe they can use that, for example, if they can prove the data breach, if they have something similar, we can use that incident number as the trigger. And one thing about the parametric insurance is they tend to make the product simple. For example, for Qomplx case, actually they have like 3 types of covers: the data breach, the cyber service outage, and the terrorism disruption. So in this case, I guess, firstly, it cannot be like a simple, it cannot be just like one product covering all 3 aspects. Firstly, we need to break it down to like 3 products. Then for example, for like the third-party liability, it will not really be the same as the cyber indemnity insurance, which cover like the total claim from the third-party liability. It could be like a fixed payment. So I guess one of a potential trigger can be when the third party sue the company, when you prove that there's a lawsuit. Just I guess, yeah.
Yeah, I think in terms of designing the trigger, one of the key aspects would be transparency as well, which is to say that both the insured and the insurer are in agreement on that data source. So something like cyber service outage, which Christine touched upon, like there's a lot of your services today would depend like on eventually AWS or Azure or Google Cloud. And if any of these fail, there's a knock-on effect on many other services as well. So, you know, being protected